So by blending large, medium and small companies, we try and take some of that volatility out, yet get the growth from the smaller companies that both in capital and income terms have been the biggest contributors.
Hello, you're watching Proactive. Joining me in the studio today is James Henderson. He's co-fund manager of Lowland Investment Company. James, very good to have you here.
Good to be here.
So James, for somebody who's never heard of Lowland before, can you tell us more about the trust, what it does and who it's designed for?
It's a special sits income fund. It should sit alongside other holdings because it is different, and that's why it performs differently over time. It's a mixture of large, medium and small companies. It's got a recovery bent to it, and a lot of the holdings in it perhaps people haven't heard of. It does less in those big famous companies and more in the medium and smaller companies that will be hopefully the big companies of tomorrow.
I'll ask you about a few of those in a moment, but first of all, you said the trust blends large, medium and small companies. Why is that mix so important, and how do the three different sizes complement each other in your portfolio?
Well, I've run it since 1990, and over that period the smaller companies have given the best returns, both in capital and income. They have their poor periods, the small companies. So what we try and do is rotate a little bit out of those smaller companies when the valuation is high, and when the valuations fall, like they have for the last few years, we're buying those small companies again and reducing the bigger companies. The bigger companies have performed better and held up better of late, but their valuations now look fairly full. So we move between the two. As I say, when you look over time, the smaller companies have given better growth. But the trouble is they've done it in this very volatile way. So by blending large, medium and small companies, we try and take some of that volatility out, yet get the growth from the smaller companies that both in capital and income terms have been the biggest contributors.
You describe yourselves as having a strong valuation focus, James. What does that actually mean in practice? What are you looking for that other fund managers might be missing? Well,
we're looking for companies that might be out of favour because of operational difficulties, short term, that we believe they can get through. That's quite part of the portfolio is in that type of company. So these companies might have quite a lot of turnover, but they're not making much profit on it. We believe that, and having analysed them, some of those companies will get better at making money out of it. So something like Rolls-Royce is in the portfolio. We bought Rolls-Royce when it wasn't generating cash, but it had a lot of business there. It had excellent business there. They are great engineers. We saw that, and we just wanted that to come through in time in the earnings numbers, and with the current management team that has happened. So we're looking for companies that are substantial businesses in their own right often, but they're not making a proper return on that turnover. So we always screen for turnover to market cap. So how much is your pound buying of turnover? And then do we believe that turnover can get a better margin?
Trust has a progressive dividend policy, James, so currently yielding around 4.2%. How do you balance the need to deliver a growing income with the objective of also growing capital?
That's a great question. We approach it slightly differently to that. We believe if you grow the capital and have a mild income discipline, then the income follows. So the first and most important thing is to grow the capital, make the cake bigger. And as you grow the cake, the income grows with it over time. So you mustn't ever bleed the capital. You mustn't ever do something just for the income. You must always first start with everything we own in the portfolio. We believe will become a bigger company in time, and then those companies generate more cash as they become bigger companies. They pay out more dividends. So dividend is a function of capital. I don't see them differently, and that's very important. It's very important, and perhaps differentiates us from some other income funds that perhaps focus on the yield. The yield is the product of growing the capital for us.
You're currently trading at a 10% discount to NAV, James. How do you explain that to investors? And do you see this potentially as a buying opportunity for investors?
Well, as I said, I've run the trust since 1990, and in that time it's been at a premium and a discount, and somewhere between the two extremes at the moment at 10. And remember, if you buy it at 10% discount, you get 110p of assets working for you. So you get a higher income for your pound spent at a discount. discount. So buying income funds on a discount is a good thing to do from your income point of view. The discounts come and go. At the moment, smaller companies particularly are out of favour in the UK. The UK is a bit out of favour as well. So the international investor, some of the bigger investors have sold down their UK weightings. They will come back. And we will see that interest return, and we'll see discounts tighten up again in time, I believe.
How has the trust performed relative to the FTSE All-Share Index, and what's been driving returns, James?
Actually, for the fact sheet, our fact sheet would show that to the end of February, the trust was up 42%, and the index is up 27% in that period, and it's up 92% over the last 5 years. These are very strong returns. Obviously, we've given that back some of that in March, but we'll get the figures shortly on that. But what's driven that has been the value that's slowly coming out of the UK market. So we've seen the portfolio, because we're buying cheap, strong companies that just might have a short-term earnings worries. A lot of those companies are the kind of companies that other people want to take over. So we've had 4 or 5 takeovers this year, and that has boosted the return from the smaller company area. We've had some good recovery stocks in the major companies, the banks, and something like Rolls-Royce the year before last really helped those returns. So it's a mix, and that's important. I like to see returns come from different areas. We want diversity, and diversity is what helps you. So at the moment, as I say, March has been a difficult month, but there's quite a lot in oil. So that is helping us when the rest of the market is more difficult. Diversity, not wanting returns to come from one isolated area, you're wanting them to come from different pockets. And it is that just paying attention to that diversity. The portfolio has about around 100 stocks, because we've got that medium and smaller company exposure, and that helps in these difficult times. So one company having a difficult time doesn't overall affect the NAV.
Could you give us a couple of examples of other cheap, strong companies where you're seeing value, James?
Yes, in the smaller company area, there are a lot. One we've been buying recently would be Marshalls, the Marshalls of Halifax. It's expected that the domestic demand for housing products will suffer if rates go up. But this is a very strong company, and strong companies weather these sort of things and come out the other side in a better position, and we would expect those building materials companies, the best building materials companies, to be very good long-term investments.
You've been running the trust alongside Laura Fall for a number of years. What would you say genuinely sets Lowland apart from other UK equity income funds, and why should an investor choose your trust over your competitors?
It is this mix of large, medium and small. So you're getting more in the UK than in other trusts. Other trusts often have more in bigger companies, which are more international. Well, those companies are more highly valued, so you are getting shares that are cheaper on most valuation grounds by buying this, but you're getting a blend of large, medium and small, and I expect the recovery in some of the medium and smaller ones to be quite marked over the next few years, and that will help drive NAV.
James, it's been a pleasure having you in the studio. Thanks so much for coming through.
Thank you very much.
That's James Henderson. He's co-fund manager of the Lowland Investment Company.